If you own a home, or if you're even thinking about it, you are operating inside one of the most complex, massive, and, well, powerful financial systems in the world. Welcome back to the Deep Dive. Today, we are taking out the architectural blueprints for really the foundation of American wealth, the U.S. mortgage industry.
Yeah.
We're talking about the financial plumbing that underpins homeownership, drives economic stability, and, ultimately determines whether you can get that signature 30-year fixed rate.
And we're not just looking at a local bank branch. We are diving into a system of, well, colossal scale.
How big are we talking?
Our sources confirm that the U.S. mortgage market is now. It's a staggering $12 trillion industry.
12 trillion.
Yeah. And just to put that into perspective, that figure alone makes it one of the largest single asset classes globally.
12 trillion. That's a number so immense it almost loses its meaning.
Yeah.
But I guess we have to remember that scale, it creates complexity.
Absolutely. Because it's so vast, this market it's deeply interconnected. It functions as this nexus point where, local banking meets global capital, where government policy from the Federal Reserves moves to specific housing agencies.
Yeah.
It dictates daily transactions.
So when I get a loan, I'm not just dealing with my local lender.
No, not at all. You're accessing a pool of money that likely involves pension funds in Asia or sovereign wealth funds in the Middle East.
Yeah.
It's far more than a simple transaction. It's an integrated global engine.
Which is exactly why understanding the architecture is so critical. So our mission today is to extract the fundamental components, who the players are, how the money actually flows, and maybe most importantly, why U.S. lending behaves the way it does.
It's a unique system.
It really is.
Okay, let's unpack this structure.
To start, we have to divide the entire system into two essential codependent pillars. You have the primary market and the secondary market.
And every single loan exists in both worlds.
Every single one. It starts in the first and almost immediately gets moved to the second. So if you're the borrower, you're only ever really interacting with the primary market. That's your front door.
Correct. The primary market is the consumer-facing side. This is where applications get filed, credit gets checked, underwriting starts, rates are offered, and, the loan is funded at closing.
And the participants here are the names we'd recognize.
Exactly. Mortgage brokers, mortgage bankers, the traditional retail banks and credit unions, and, of course, all the emerging fintech lenders. Their focus is on customer service, compliance, and suitability, basically, making sure you can actually afford the house.
But the lender who just handed you that check, they don't, statistically speaking, want to hold on to that loan for the next 3 decades.
No way.
So almost instantly, that loan gets pushed into the secondary market.
Precisely. The secondary market is the liquidity engine. If a primary lender had to keep every loan they originated, they would run out of capital so fast they'd just have to stop lending. So by selling that asset, that loan, immediately, they free up their capital, they reduce their own long-term risk exposure, and they maintain liquidity. And that allows them to originate more loans.
Wait, so I could close on a $400,000 house on a Monday, and my lender might sell my loan on Tuesday?
It could be that fast, yeah.
That sounds incredibly impersonal.
It absolutely prioritizes efficiency over relationship. That's a core tension in the whole system. But this is where the brilliance and, frankly, the risk lies. The secondary market is essentially a massive asset buyer.
And who are the biggest buyers?
The biggest are the government-sponsored enterprises. Fannie Mae and Freddie Mac, as well as Ginnie Mae and various private investors.
And these investors, they're not buying individual loans one by one, are they? They buy them in bundles, which is where the famous or maybe infamous mortgage-backed security, the MBS, comes in.
That's the one. The MBS is the fundamental mechanism that allows global capital to flow into U.S. homeownership. Think of it like this. A loan is just a stream of payments over 30 years. You take thousands of those individual streams, some a bit higher risk, some lower risk, pull them all together, slice them up, and package them as a security that can be traded on global exchanges. It's like a highly specialized bond.
And pooling them together dilutes the risk of any one person defaulting.
It dilutes the individual risk and makes the asset attractive to these huge institutional investors who need predictable long-term returns.
That makes the so what for the borrower crystal clear. Because the secondary market exists, the primary lender can sell off the risk. If they couldn't, they'd have to charge us just astronomical rates to compensate for holding a 30-year liability.
Precisely. This is the crucial takeaway. The common stable 30-year fixed mortgage, which is a fixture of the U.S. system, is only possible because the secondary market, through its investors, is willing to absorb that long-term fixed-rate risk.
I had no idea.
In most other countries, you get variable rates, or maybe a rate that's fixed for 5, 10 years, and then it resets.
Right.
We have global capital markets to thank for the stability of our monthly payment.
I never thought I'd be thanking global bond buyers for my mortgage payment. Okay, let's get specific about the players, especially the ones setting the rules for what gets sold.
Well, we have to talk about the government's immense influence, primarily through the GSEs, Fannie Mae and Freddie Mac.
Right. And as you said, they do not originate loans. They don't talk to borrowers.
Never. Instead, they buy loans from primary lenders, they pool them, and then they guarantee them. And that guarantee is what makes the MBS so attractive to investors.
So they're kind of the gatekeepers, deciding what's a good loan worthy of being sold on the secondary market.
Exactly. Their guidelines, known as conforming loan standards, are the universal language of the industry. These standards dictate everything: acceptable credit scores, the maximum debt-to-income ratio, or DTI,
And all the paperwork?
all the rigid documentation requirements that every primary lender has to follow if they want to sell that loan. It creates uniformity, which you need for mass securitization.
So a local mortgage banker in, say, Omaha has to follow Fannie and Freddie's rulebook, even if they're not technically working for them.
That's the entire industry model. The GSE standards basically define what a good loan is.
Okay. And what about Ginnie Mae? How is that different?
So separate from the GSEs, you have Ginnie Mae. Ginnie Mae focuses exclusively on the government-insured segment. It creates MBS specifically from loans insured by federal programs like FHA, VA, and USDA.
Ah, so that helps fund loans for first-time buyers or veterans.
Exactly. Those loans might not meet the stricter conforming standards, so Ginnie Mae ensures they still have a robust funding source.
Okay, let's go back to the primary market. How do the actual originators differ? We have the folks on the front line, the mortgage loan originators, or MLOs.
The MLO is your navigator. They're taking your application, crunching the numbers on affordability, helping you pick a program, but how they source that loan can vary. You have mortgage brokers whose value is pure shopping. They do not lend their own money. They work with dozens of different lenders to find the lowest rate and the best program.
Increasing competition for me, the borrower.
Right. And then you have the actual institutions lending the cash. The traditional retail banks and credit unions might offer mortgages alongside your checking account. They might even portfolio some loans, which means they keep the risk on their own balance sheet.
But that's becoming less common.
It is. The rapidly growing segment is the mortgage bankers and correspondent lenders. These are often non-bank or fintech companies. They fund the loan, but they are highly optimized for one thing: closing the deal fast and immediately selling that asset.
They're built for speed and volume.
Exactly. They're built for quick origination and quick transfer of the risk.
That's a really comprehensive cast of characters. We've got the originators, the regulators, the buyers. Let's tie it all together now and follow the money. How does this continuous cycle actually work?
It's a really elegant, self-fueling mechanism that, just never stops. We can trace the path of capital in a loop.
Okay, start with me, the borrower. I apply, and the primary lender funds my loan at closing. They now hold the asset. What's step 2?
Step 2. That lender immediately sells the asset, your loan, to a GSE or a private investor because they need that capital back. Step 3. The GSE or investor bundles your loan with thousands of others, pooling the risk, and packages them into those mortgage-backed securities we talked about.
And step 4, global investors, the pension funds, insurance companies, they purchase those securities because they want those guaranteed long-term returns. That money is now flowing into the U.S. housing system.
Exactly. And steps 5 and 6 are the return flow. That investor capital flows back to the GSEs, who use it to buy more loans. And crucially, that capital then flows back to the primary lenders, who use that replenished cash to originate new loans for the next round of buyers.
So it's a loop. Lending, selling, securitizing, investing, and replenishing.
That's it. And if any one step in that loop slows down, the whole system can freeze up.
And because that loop is driven by the global bond market, that's why my rate quote is never stable. It's not just the bank across the desk setting the price.
You got it. The rate you are offered is just a reflection of investor demand for that whole pool of assets, the MBS. The rate is set by massive macroeconomic forces.
Like the Fed's actions.
The Federal Reserve's actions, for sure, directly impact the bond markets, which determines investor appetite for the MBS. Inflation is also a huge driver.
I always thought the Fed controlled mortgage rates. But what you're saying is that the Fed controls the short end of the interest rate curve. But the mortgage rate is really a function of the long end of the bond market.
That is Precisely the insight. When investors are confident, they demand more MBS, driving the price of those securities up, which allows lenders to offer lower rates.
But when they're scared,
Conversely, if there's instability or high inflation fear, investors pull back, demand for MBS falls, and mortgage rates spike, which directly impacts your affordability and slows that whole loop down.
okay, let's connect this back to the borrower's journey. When I go to get a loan, I'm doing a bunch of steps. But these steps aren't just paperwork. They're necessary verification points for that secondary market sale.
Agreed. The consumer's journey is really just the process of turning a complex set of financial circumstances, your job, your debt, your credit, into a standardized saleable asset.
So, stage one, pre-application. I'm gathering all my proof tax returns, pay stubs. Why does the secondary market care so much about my pay stubs?
Because that paper trail is the proof of the income stability that's required by those GSE conforming standards. If the income documentation is weak, the loan can't be guaranteed and it can't be sold.
Okay. Then stage two is the official application, the 1003 form. This is the data input.
Exactly. And that data feeds the system's compliance checks. Then you get to stage three, disclosures. This is where federal laws like REP and TALA kick in to mandate transparency. You get the loan estimate and later the closing disclosure.
And stage four is processing. The processor is verifying everything.
Right, they're calling employers, checking bank statements, and ordering the appraisal. And the appraisal is vital because the secondary market needs to know the value of the collateral, not just your credit worthiness.
Which brings us to stage five, the central gate, underwriting.
This is the final check against the GSE standards. The underwriter assesses the totality of the risk, your credit, your DTI, the property itself. They're basically asking, will this loan sell to Fannie Mae without a problem?
And if the answer is yes, you move to stage six, approval and closing.
Right. The loan gets signed, funds are dispersed, and then the cycle moves to its final stage for the lender. Stage seven, selling or retaining. They make that calculated decision, push it to the GSEs, sell the servicing rights, or maybe keep it.
This entire complex, multi-layered machine, it only functions because of the regulation you mentioned earlier. Why do we need so many overlapping regulatory bodies, the CFPB, the FHFA?
Because where there's $12 trillion in play, there is massive vulnerability. The complexity itself is a weakness. It's susceptible to fraud, predatory lending, discrimination.
I see.
The existence of bodies like the CFPB, which is a consumer watchdog, or the FHFA, which oversees the GSEs, is a direct historical response. I mean, the 2008 crisis drove massive changes to these rules, resulting in much stricter disclosures, like the loan estimate.
To stop people from being misled.
Exactly, to combat the historical problem of consumers being surprised and misled at the closing table.
So the regulation isn't just bureaucracy, it's systemic maintenance designed to stabilize the whole structure and protect the consumer who's at the very beginning of that $12 trillion chain.
Mm-hmm.
So when we circle all the way back, what are the net benefits for me, the consumer, of this heavily engineered system?
The benefits are really substantial, and they come directly from this design. You get highly competitive interest rates because the secondary market is so efficient at absorbing risk. You have a wide array of loan products, many backed by Ginnie Mae. And crucially, you get the stability of that 30-year fixed rate.
Which is rare outside the U.S.
A huge rarity.
Yeah.
All made possible by the efficiency of this complex structure.
So at the end of the day, it's the secondary market's ability to constantly replenish capital and redistribute risk that keeps the primary market competitive and functional for every single borrower.
That's it. That continuous cycle is the foundation.
Which brings us to our final thought for you to chew on. We've established that the entire structure of U.S. homeownership, particularly the stability of that 30-year fixed mortgage, relies completely on global investor demand for mortgage-backed securities. We are, in effect, selling pieces of our housing market to the world. So what happens to U.S. homeownership stability if that global investor appetite drastically changes? Perhaps due to a sustained flight of capital away from U.S. assets, or a fundamental long-term global economic pivot toward other types of security? What happens when the money flowing back into the system suddenly slows down or even reverses? That's something to mull over until our next deep dive.